picking the stocks, picking the investments, to be honest with you, that's one of the easier parts of the job.
I agree.
But it can be really hard to stay invested when it feels like the sky is falling.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John today.
Morning.
And Lee.
Good morning.
How are you guys?
Good.
Great.
Good to
Doing
be
great.
back.
Yeah, you
It's
were
been-
out.
It's been a few weeks since
Yeah.
I've sat behind the desk.
Yep, we had a lot going on. Some conferences,
Sickness.
sickness,
I mean-
people out on vacation. Yeah.
It's good to be back.
I'm still homeless, like we talked about last week. So,
And the week before that.
yeah. So, a lot going on, but market's just plugging along,
Keep moving.
grinding forward. So, today we wanted to talk through just some charts. We're going to throw these up on the screen for you. So we subscribe to a really cool service that sends these charts to us every single day with updated data. So it's called Exhibit A, and it's really slick and just puts some really user-friendly, easy-to-understand charts for us to talk through. So a couple of things we want to talk through today. With the markets hitting all-time highs, all of the indexes either at all-time highs or near all-time highs, it is very, very easy to say, well, I don't need to invest right now, right? We're at all-time highs. And this chart, it's titled Don't Fear All-Time Highs, shows you that the forward 1 year, 3 year, and 5 year average return since 1950 for the S&P 500, you have actually outperformed if you invested at all-time highs on a 1 year, 3 year, and 5 year forward basis.
Pretty awesome.
That's
and that goes contrary to what human nature would tell you. I mean, how many times do we have clients in our offices that will say, I don't think I want to get in now?
Yeah.
We're at
yeah.
highs.
Oh,
Well,
yeah.
how often are we sitting in the chair and your gut is telling you now's not the right time?
Yeah.
We're just hitting. I mean, that is just, for whatever reason, the natural instinct to think, oh, it's at a high.
Let's wait for a pullback.
Wait for a pullback. And there's still ways to do things, in a wise way. Like if you're investing a large amount of money, you might still dollar cost average in if
Sure.
you're at all time high. Like there are still things that this chart isn't the end all be all, and doesn't mean that like you couldn't invest in all time high and experience a quick pullback all of a sudden. But it does kind of go to show you that like you shouldn't be afraid of the market hitting highs.
No, you're going to have a slide you're going to talk about here in a few minutes exactly showing that point.
Yeah.
If you miss the 1 day because you're worried. So go back to Trump tariffs, April 2nd. Market goes down massively. We have like a week of just everyday down, very bad down, right? 15% down in a very short amount of time. And I know you're going to talk about this later, but that's exactly the point. If you got emotional. So the other side to that coin is like people don't want to invest at all-time highs. But the other thing, people don't like to invest when the markot's going down either.
No, and
right?
that's
like,
the whole point is like just get invested.
and
whether it's
motion out of it.
Whether it's all at once or over a period of time,
Yep.
just get invested because it's never going to feel like the right time.
Exactly.
It's never, because if the market gets cut in half and we're down, you might be sitting there today and saying like, man, I would be sitting there ready to buy. If the market just got cut in half, I promise you're not sitting there saying like, I can't wait to get in on this thing.
Right.
Because you're just like, how much lower can it go?
Right.
It's
well,
gonna keep going
2008, Lee and I, we went through that 2008, 2009, and I remember literally vividly the day that it hit the bottom, March 7th of 2009. I remember that. And our clients, when we called them to say, hey, it's time to get back in or whatever, nobody wanted to get back in. They thought the market was just never going to recover. U.S. was totally toast, which we know
Yeah,
obviously
it never
is
feels
not,
like
not
the right
right
time.
And,
So-
and the market's gone nothing but up. If you missed out on that, if you'd invest in the entire 08 54% downturn and went through all that and then just stayed out emotionally out of it, today you'd be so high above the person that got out 20% down and didn't get back in until
But Matt,
market
to
was
your
up
point, it
50%.
is very interesting. If we listen to clients or if we listen, there's never a good time. It's either too high.
Well,
I don't want to get in when the market's falling. the market's hit a low. I mean, it just.
Well, and I mean, in the client's defense, I would put advisors in the exact same boat. If you let the human, like,
Correct.
what do you want to do? What feels right? I think good advisors have just either been through enough or, have done enough research to know that, like, you can't make decisions based off that. So there are plenty of times where I don't want to. I just know the research, the numbers, and the data say this is the right thing to do, because I think I often personally, like, agree with clients more than I disagree, just on the emotional side of things, right? But you can't make decisions that way. Just like I tell clients all the time about, like, if we're going to dollar cost average into the market or dollar cost average out of the market, like, you have to set a schedule and stick to it, because you can't be like, well, we're going to do this and we're going to do it when it makes sense, and then because then you're just going to be all over the place.
Well, it was probably 15 years ago that my mindset shifted, because to your point, Matt, you were talking about even advisors. I fell into the trap. If we're hitting highs, or if a specific stock or investment hit a high, back when I was in Little Rock, we heard from a investment guy in New York that stated that once a specific security hit an all-time high, it would hit 72 more all-time highs before a significant downturn. And that has stayed with me. And so it really shifted my thinking of, don't be afraid of getting into the market or specific securities.
Right. Well, let's jump ahead to this.
Good slide.
This third slide. I think this is more directly correlated kind of what we were talking about. So if you panic sold and missed the best day of 2025. So April 9th was the best single day for the S&P 500 this year to date. This is absolutely mind-boggling. So if you missed one day, if you cashed out, say you sold, missed April 9th, and then immediately got reinvested, you have underperformed by 9.5%. This data is through the 25th, so Friday.
Unreal.
That is, that's crazy. So
no, that's the point. It's a massively good point.
You always hear these, like, stay invested, time in the market beats timing in the market, and you're like, blah, 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 blah. And then you see, like, the numbers and you see the financial impact, and you're like, oh, shoot, like that.
Did you guys have a lot of clients call you guys during the Trump tariff scare in early April?
No, not.
I had one.
I had questions in meetings.
Yeah, in meetings, but
not concerned.
I had one client call and was concerned.
I actually did have one client call like 4 times, but
I basically was like, this is be below. I kind of gave my spiel of don't get emotional, don't make a bad decision right now. And of course, but I only had one out of all of our clients, right, that we serviced for the years. That's a pretty good story. So we've kind of gotten our clients a little more emotionally prepared. But secondly, a lot of clients don't pay attention like we do on a day-to-day basis and see the beating it was taking. But to your point about missing that one recovery day cost you so much in return.
9.5%.
It's unreal. Missing that one day, it's unreal. Anyway, great chart. I'm looking back at a chart on the S&P going back 25 years. Do you guys realize that since March of 2009, the S&P has, March 7th of 2009, the S&P is 10 times higher. And that was the day when the low, right? And everybody was panicked, and a lot of people got out and never got back in. And you went up 10 times your money had you stayed in the S&P 500 for that short 16-year period. But anyway,
but interesting. This slide deck, Matt, that we have access to, and we're not going to cover this one, but down days happen, down weeks happen, volatility is normal, and I think that part of our job as advisors is to manage to the April 2nds of the, what that we deal with. We're never, no matter how good things are, we can have great bull markets, and we can still experience shocks, significant.
Yeah,
pullbacks.
You should expect to.
Absolutely. So.
In fact, we've had moments this year where the tariff talk, the Israeli-Iranian conflict, the Fed not lowering rates, we've had things that could have rocked this market, and they really haven't. Besides short-term little shock moments, the market has powered through all of that. I was looking at the all the stocks, and the Mag 7 is a big story, right? The Mag 7 was leading the market for so long, and I still think they are. I think AI and technology, we are the best country in the world for our technology companies, and the artificial intelligence is still going to continue to move us forward. But I was looking at the price to earnings ratios of the Mag 7, and they're still fairly valued. It's not like this is way out of whack. That market downturn in April, the market actually got to fair value when that got down 15%, which when it hit that on the way up the first time years ago, the market was overvalued quite a bit. So the stock's earnings have caught up.
What are you saying?
To the price.
This is just for a moment because I don't know what you're referring to when you say overvalued.
So I look at like the PE ratio. The historic average PE ratio on the S&P 500 is around 16. So when you get into the 20s, you're overvalued. Price to earnings ratio, price divided by earnings. So you're just getting higher. So like tech stocks and pharmaceutical companies they're constantly looking at new drugs and so on. Their price to earnings is usually a little higher because it's always about new innovation and new things coming later. So there, you think of like tech stocks, fair market PE would be around 30, where the value stocks would be around 15, the overall market around 16. So I'm just looking at valuations in that regard. But
got it.
As an example, Google is still in the 30s on their PE, and companies like that have been high flyers for so long. Their earnings have caught up to their price rather than their price coming down to match earnings. Right? It's gone the other way.
NVIDIA. I mean, what was NVIDIA's PE ratio was. Like a couple years ago. I mean, it was, I forget off the top of it.
1,000. It's at one point.
It was like
stupid.
Astronomical.
Yeah.
And you're just like, there's no way this is sustainable. And we were right. It just corrected itself by
the price by the
money
earnings
instead of the price coming down.
Amazon had the same story for years, and you either have stocks getting back to valuation by coming down in price or earnings going up, and we've had this magical run of really strong earnings.
Yeah,
and they continue to happen as long as they continue to be good. Second quarter earnings, good so far. The market just can continue to go.
NVIDIA's PE is 57.
Yeah, which is high in comparison to other stocks, but it's low compared to what they've been.
I mean, things are pretty strong right now. I'm tempted to quote Jim Cramer, but I don't want to have to bleep.
Oh my word!
Oh,
yesterday that was amazing. Okay, so here's one thing that's been interesting about this year. Diversification has helped. International
picked it up
back for the first time in 15 years.
Yep.
Fixed income.
Yep.
Is up.
Yep.
So,
gold
I was
at
a conference last week, and somebody made the comment that U.S. exceptionalism is still there, but the rest of the world is catching up, and it is. Ex NVIDIA. So if you remove NVIDIA from the U.S. stock market, Europe and Japan are outperforming the U.S. markets.
Which is amazing.
It really is.
Now, Europe and Japan have stunk for a long time, right?
That's the thing. Is like they should. Like,
they've got a lot of
periods of
time.
Yes. Europe and Japan are both great markets and economies, right? Not as good as ours, but there should be it makes sense for there to be periods of time where they do keep up or outperform. There shouldn't be one country that just year over year, forever, into perpetuity, always outperform.
Correct.
And so as you're building portfolios as we are, it's nice to see, hey, we can actually diversify and keep up, because it's not just buy the S&P 500 or buy 10 companies.
Exactly.
Correct.
Because that's the only thing in the world that's working.
We've added international and bonds, which I think is fantastic, right? We've started to get nibble back in on those in the last year or so, which has been really smart and it worked out really well. The market does not. I always love hearing this. The American market is the only market that's going to work forever, and I laugh at stuff like that because it is cyclical, even though it takes sometimes a long time for other things to catch up.
Right.
But bonds are back to that, where you can do those models where the bonds actually work. And the European markets, Japanese markets, it's fantastic. I actually think it's great that these things are
absolutely
where we can use it, man. I love it.
The 60-40 modern portfolio theory may not be dead after all.
No, it was dead for 15 years.
It was for
and
a
now
while.
I think it's going back to life.
It's back on life support.
Yeah,
So,
exactly.
Last chart: S&P 500 versus the S&P 493 versus the Mag 7. It's a lot of versuses, but Mag 7, Magnificent 7, top 7 stocks in the S&P 500. You all know the names. So this is comparing the total index versus the Mag 7 and then the other 493 companies. And you can see year to date, the 493, so the S&P 500 X Mag 7 is actually outperforming, which is like, again, it's
goes to
is
what
great.
we're talking about. Things
Which is
that have
great.
laggards over
Yep.
the past several years.
Yep.
Financials,
Yeah.
the biggest one. I
Yep.
mean, financials have roared back
Yep.
because they were dead for a long
time.
Yeah, this is asset class returns year to date. So you have international stocks up big, emerging stocks up big, U.S. large cap, commodities, REITs, tips.
Unreal.
But
Yeah,
like
you don't see
you're
those.
getting performance out of all kinds of tips up 4.8%.
Yeah.
Mid cap stocks have done well. Bonds have done well. Cash has done well.
Cash is
Yeah.
outperforming
Yeah.
small cap.
Yeah. So, anyways, it's
Well, the moral of the story is like don't get emotional, right, when you're investing. There is no wrong or right time. We don't know. Only a time machine would be able to tell when the perfect time is to do something, and you cannot ever find that.
not to interrupt. That what you get wrong investing is by investing the wrong amount of money. So if you have $250,000 and that is your entire nest egg, where you mess up is by investing the entire $250,000. It's not by it's not the timing of that investment. You need to make sure if you have the appropriate amount of cash reserves and you have money in places that's safe that you can get to, that when things do go south, you have access to some money. So maybe that 250, you take 150 of it and say, hey, we're going to invest this. That is how you set yourself up for success, not by trying to take the 200, 250 as much as possible and getting in or out at the right time. So that's about having the plan, having the right money in the right places, and then just get invested.
Exactly. One other thing, if you're working still and you have a 401k or you're investing on a monthly basis, bi-weekly basis, whatever in your 401k, you're buying shares and you just keep doing that. That's the win-win-win formula, right? Doesn't matter what the market does. You're always buying more shares, and your lack of a better term, you're taking that 250, you're spreading it over time because you're getting paid, if that makes sense. Your paychecks are going in there and you're getting your matches. So you should understand when you're buying the market, if you're still working, you can be a little more aggressive on the future payments. But if you have 250, like you said, you need to know your risk tolerance number, you need to know your plan, and then all of that other stuff works out, if you're diversified properly. Anyway.
These charts are great. The big news over the weekend, which we're going to spend 30 seconds talking about, the tariff deal with the EU, huge.
Huge.
That was good. The tariff uncertainty is starting to go away. Not every country has a deal yet.
Right.
But getting EU, getting Japan, those are two of our big trading partners. China, we'll see if that one.
That eventually will work out.
I think so, but
I think
the
so.
EU deal,
It's big.
it's a big deal. They're
big deal.
I think our single largest trading partner.
Yeah. The biggest fear
The
of all
EU?
this tariff stuff was that, the biggest fear was that it would just all the countries are gonna stick their nose up to America and it was gonna be over and they were just gonna work with each other. But the reality is we're the number one consumer in the world by far, and the world needs the U.S. consumer. And I think that's that's on our side, right? That's the cards we have, like as Trump would say, he's holding the cards. And I don't disagree with that at all. And I do think China will eventually come to the table because their economy desperately needs the U.S. consumer.
So wait, on the
To a point.
EU, this showing my ignorance here. So everyone that's part of the European Union just kind of has to fall into line, and that's their trade agreement.
Yeah, they get a say in it, but every country has their.
like
But we're not.
socialism
But
at
we're
that
not negotiating with France and
Right.
Spain, and it is
Just
the collective EU. Yeah.
which Switzerland and England are out of.
Right.
So we have to, but we have one already with England, right? So it's and I don't think.
the Swiss. It's like
One thing that was interesting.
everybody loves the Swiss.
Yeah, exactly.
I don't know if you noticed this. This is completely off topic, but when they were announcing their deal over the weekend, Warren Stevens was sitting next to President Trump.
That's
he's
pretty
the
cool.
ambassador
To-
to something over there,
don't
United
know.
Kingdom. England, something.
Yeah.
But yeah, Warren Stevens was
Which is awesome. He's
It is very good.
Arkansas
Warren
guy.
Stevens.
so.
He is ambassador to the UK.
Okay.
That's pretty cool.
He was in the room.
Okay, so we've referenced this chart in the past. I keep pulling up new charts I didn't tell you all about. Sorry, but the importance of staying fully invested. We'll end with this. This is since 1950. If you've stayed fully invested, you've annualized an 8.3% return. If you've invested in the S&P 500, if you miss the best day of the year every year since 1950,
cut in half.
Just over 4%.
1 day a year.
You've missed the best 5 days of the year. You're negative. You've compounded at a negative rate of return of 4.3%. And if you miss the 10 best days, you've compounded at a negative 12% return. So you can see that. And yes, these are extreme examples. You know, you're likely not going to miss the one best day of the year in the market for 75 consecutive years.
Right.
If you do, then we need to talk. But it does go to show you how one or two bad decisions can really make a lasting impact.
Okay, I'm gonna piggyback onto that one. If you put it in dollar terms, if you invested $1 in the S&P in 1950, and if you missed the best 100 days over the last 70-something years, you'd have 5.
Wow.
If you were fully invested,
Yeah.
you'd have 383.
Wow.
I mean,
Yeah.
people can understand percentages, but if you put it in dollar terms, if you'd invested $1 and you missed 100 of the best days, you would have a $5 bill.
Yeah.
You know,
Isn't that
that's amazing. Now,
Well,
the other thing.
Sorry.
Yeah.
We're just trying to keep John from talking. The thing about that, typically the best days follow the worst days. And so when you might say, well, it's like, well, what are the chances I'm going to miss the best day? They're probably higher than you think, because the worst day is going to be the day you want to get out. And then typically that's when the market will see a bounce, and you'll have those big kind of outlandish days on the back end.
For years, I have told my clients, you may look like a genius coming out, but you'll be looking like a fool trying to figure out when to come back in.
Yeah, it's so hard.
Yeah.
It's so hard. It's almost impossible to get reinvested.
Yes, let's keep talking so John doesn't.
Hey,
I love the fact that we will say, hey, didn't mean to interrupt, but we just still plow through.
8% per year average return since 1950 is the most important number, because we have far outperformed that the last 15 years with a few exceptions. So the expectation of people is sometimes I worry that we expect too much, that we're going to get 20% a year from the S&P. The actual reality is somewhere around 9. So we've been and we might keep outperforming for a while. But the expectations, our job is to help us keep good expectations as well. Anyway, that's all I was going to say.
Yeah, for sure. Okay, well.
Thanks for giving me the time. I appreciate that.
Yeah, interesting thing. We, to be honest with you, we came in today and we're like, what do we talk about? Let's just talk about some charts and some market data. So interesting stuff. It's always, we've talked about most of these charts before, but this is updated data, real time, after kind of seeing the market correct and then come back here at the beginning of the year. So I think just always a good reminder of, emotions, market, psychology when it comes into, that's one of the most important things that you can be aware of when it comes to investing, is just how hard it can be from an emotional and psychological perspective. Picking the stocks, picking the investments, to be honest with you, that's one of the easier parts of the job.
I agree.
But it can be really hard to stay invested when it feels like the sky is falling.
Sure.
Right.
So just be prepared for that. Have a plan. Know what your risk tolerance is. Make sure you have the cash you need outside of the market so that you can withstand those volatile swings. And then have an accountability partner, whether that be an advisor like Mach 1 or a buddy or someone that you trust. Have someone that you can talk through with. So appreciate you guys. Look forward to talking to you next week. Be sure to give us a like, subscribe, and share. We'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.